Something unusual happened in the bond market this week, and almost nobody outside professional trading desks noticed. The 30-year Treasury yield, the rate the U.S. government pays to borrow money for 3 decades, climbed to its highest level in 19 years. You have to go back to before the financial crisis to find a moment when it cost Washington this much to fund its longest-dated debt. Most financial media buried it under the day's stock market headlines. But if you understand what long bond yields actually represent, that treatment is backwards. This is closer to a confession than a footnote, a confession about what the largest, most sophisticated pools of capital on earth now believe about inflation, government borrowing, and the credibility of the institutions running the world's reserve currency over the next 30 years. And when that confession happens quietly in a market almost nobody watches, it tends to matter more, not less. The reaction in gold and silver over the past few days broke the textbook pattern. In the old playbook, rising yields were bad for precious metals. Higher yields on safe government debt made a non-yielding asset like gold relatively less attractive. That relationship held for decades. It is one of the first things anyone learns studying commodities. But this time yields spiked and gold did not retreat, it held. In a few sessions it pushed higher, which should not happen if the old rulebook is still valid. Either the market is temporarily confused, or that rulebook no longer describes the world we are living in, and figuring out which of those two explanations is right has real consequences for anyone holding cash, bonds, stocks, or metal right now. Start with the plain question, what does a 30-year Treasury yield actually measure? When you buy a 30-year bond, you are lending the U.S. government money for 3 decades in exchange for a fixed interest payment. That yield bundles several things together, where investors think short-term rates will average out over that period, how much compensation they want for the risk that inflation eats into the purchasing power of those fixed payments, and a term premium on top of that, extra compensation for the discomfort of being locked in that long, layered with uncertainty about deficits, about who keeps buying the debt, about political stability. When the yield rises sharply and quickly, one or more of those pieces is moving. The bond market is repricing something. This move has not been driven mainly by the Federal Reserve raising short-term rates. The Fed has been comparatively quiet. It has come instead from the long end, the part of the curve the Fed does not directly control, the part that reflects what pension funds, insurance companies, and foreign central banks believe about the distant future. When the short end stays calm and the long end climbs on its own, traders call that a bear steepening. The plain English version, the market is not worried about next month. It is worried about the next decade, and it wants more compensation for holding government debt that far out. Think about who actually buys 30-year Treasury bonds, not day traders. It's the most conservative, long-horizon capital that exists: life insurance companies matching liabilities decades out, pension funds trying to guarantee retirement income for people who haven't been born yet, central banks managing foreign exchange reserves. None of these are impulsive actors. When this class of buyer demands a materially higher yield to keep lending money for 30 years, that's the most patient, least emotional money in the world quietly recalculating its assumptions about the years ahead. At first glance, you might assume higher yields simply reflect a stronger economy, more growth, more demand for capital, which would normally be good news. That would be reassuring if it were the whole picture. But there's another layer, visible once you look at the term premium specifically, the part of the yield that compensates investors for duration, risk, and uncertainty, separate from growth expectations. That premium has been widening. Investors aren't just pricing in more growth. They're pricing in doubt about whether the fiscal trajectory is sustainable, about who keeps absorbing the growing supply of new Treasury issuance, and about whether inflation stays anchored where policymakers say it will. Bond markets have sent this kind of signal before, and each time it told a slightly different story. In the late 1970s, long bond yields climbed relentlessly as inflation expectations came unanchored. Investors who had lived through years of price increases eroding their fixed income demanded ever higher compensation to keep lending. Gold went from an overlooked metal to one of the defining trades of the decade. Because it offered something a paper promise could not, it did not depend on any government's ability or willingness to honor its debts. In the early 2013 taper tantrum, a different mechanism was at work. The market feared the Fed would remove support too quickly. Yields spiked on that fear, and gold actually fell sharply because the driver was expectations of tighter policy and a stronger dollar, not doubts about long-term fiscal credibility. Same surface move in yields, but a different cause produced a different outcome for metals. That comparison matters right now because it tells you the current move in gold and silver, holding firm even as yields spike, looks structurally closer to the 1970s pattern than the 2013 pattern. The market appears to be pricing in a fiscal and currency credibility concern, not simply a growth or tightening concern. If that reading is correct, it reshapes how you should interpret nearly everything else happening in the metals market this year. Central bank gold purchases over the past several years tell a related story, mostly outside the spotlight. Central banks, particularly outside the traditional Western financial system, have been accumulating physical gold at a pace not seen in decades. This isn't a speculative trading position. Central banks don't buy gold expecting a quick profit. They buy it as a long-duration reserve asset because it carries no counterparty risk. A Treasury bond is another government's promise to pay, and buying one means trusting that government to remain solvent for the life of the bond. Buying physical gold means trusting nothing but the metal itself. The scale and persistence of this buying goes beyond routine reserve diversification. It suggests part of the official global financial system is quietly reducing its dependence on the long-term credibility of sovereign debt, including U.S. treasuries. Overlay that with what's happening domestically. The U.S. government keeps running large deficits that require continuous new treasury issuance, and every bond issued needs a buyer. For years, foreign central banks, domestic institutions, and the Fed's own balance sheet absorb that supply relatively smoothly. But foreign official buying of U.S. debt has become less reliable, and the Fed has been shrinking its holdings rather than expanding them. That leaves a growing pool of new debt that has to find buyers among price-sensitive private investors, buyers who, unlike central banks pursuing reserve diversification, actually demand a competitive yield. Basic supply and demand tells you what happens next: more supply, a shrinking pool of price-insensitive buyers, and the yield has to rise to pull in enough price-sensitive buyers to absorb it. That dynamic alone can explain a meaningful share of what's happening at the long end of the curve, independent of any single week's data release. It matters here to separate fact from interpretation, because these are different categories of statement, and conflating them is how investors get misled. It's a fact that the 30-year yield climbed to its highest level in 19 years. It's a fact that gold hasn't sold off the way historical correlation would suggest. And it's a fact that central banks have been net buyers of physical gold at an elevated pace for several years running. Those are observable data points. What comes after is interpretation, and reasonable, well-informed analysts disagree about it. One view holds that we're watching the early stages of a structural repricing of sovereign credit risk across developed markets, with gold as the natural beneficiary of declining confidence in fiat-denominated long-duration debt. A less dramatic but equally serious view holds that this is a temporary supply and demand imbalance in the Treasury market that self-corrects once issuance patterns normalize or the Fed adjusts policy to relieve pressure at the long end. A third view sits in between. The structural concerns are real, but building over years, not weeks, and any single data point, including this yield spike, is one more entry in a slow-moving trend rather than a dramatic turning point on its own. The bullish case for gold and silver deserves to be laid out on its own terms rather than assumed. If bond markets are losing confidence in the long-term fiscal trajectory of major sovereign borrowers, the historical pattern is fairly consistent. Investors and institutions seeking a store of value outside the government debt complex have gravitated toward gold during periods of sustained real yield uncertainty and currency debasement concern. Silver, with its dual role as a monetary metal and an industrial input used in electronics, solar panels, and manufacturing, tends to amplify gold's moves in both directions, often lagging before catching up sharply once a trend establishes itself. If the current bond market repricing continues and central bank buying persists at its recent pace, the bullish case argues that metals could be in the early rather than late stages of a multi-year revaluation, particularly if real interest rates, yields after subtracting inflation, stay low or negative even as nominal yields rise. The bearish case deserves the same treatment. Dismissing it would not be intellectually honest. Bond yields could simply be adjusting to reflect stronger than expected economic growth, in which case the Fed may eventually need tighter policy to prevent overheating, historically a headwind for gold since it raises the opportunity cost of holding a non-yielding asset and tends to strengthen the dollar. It's also possible recent gold strength reflects positioning and momentum among traders rather than a genuine structural shift, meaning any disappointment in inflation data, any signal of fiscal discipline from Washington, or any stabilization in Treasury issuance could quickly reverse the divergence between yields and gold and send the relationship back toward its historical norm. Markets that move quickly on narrative can reverse quickly when that narrative meets contradicting evidence, and a 30-year yield at a multi-decade high is exactly the kind of headline that can generate short-term speculative flows into metals that don't hold up. There's also a neutral case, and in some ways it may be the most probable one. It holds that both forces, rising term premium concerns and continued central bank accumulation, are real and operating at the same time, but that their near-term price impact will be choppy rather than a smooth, confident trend in either direction. Under this view, gold and silver could keep showing the kind of resilience we've seen this week for a while, punctuated by sharp pullbacks whenever short-term data suggests inflation is cooling or fiscal concerns are easing, without the broader multi-year accumulation trend actually breaking down. Weighing these three cases against the evidence, the neutral to bullish interpretation currently looks best supported, and not because gold going up makes for a better story. It's because the specific combination we're seeing, a sharp yield spike alongside gold holding firm rather than falling, is genuinely unusual by historical standards, and unusual divergences from well-established correlations tend to reflect the market pricing in something structural rather than something that unwinds in days. Unusual doesn't mean certain, though. This divergence needs to persist across several more weeks of data before it can be called a confirmed regime shift rather than a temporary anomaly. One more dimension concerns investor psychology rather than pure economics. Markets aren't just mechanical systems responding to spreadsheets of data. They're a collective expression of how millions of participants interpret uncertainty. When a headline like a 19-year high in long bond yields crosses financial media, it does something subtle to investor psychology, even among people who never trade bonds directly. It reframes the baseline assumption many investors hold about what a safe asset even means. For decades, government bonds sat near the top of the safety hierarchy. Cash was safe. Government bonds were the next rung, offering safety with a bit of yield. When the price behavior of the supposedly safest long-duration asset starts behaving erratically, it forces a re-examination of that whole hierarchy. And historically, that re-examination is exactly the psychological condition under which gold shifts from being viewed as a niche inflation hedge to being viewed as core portfolio insurance by a much broader set of investors. That shift in perception tends to build slowly and then accelerate fast because it's driven less by new information and more by a critical mass of investors simultaneously updating a belief they've held for a long time. It's worth being honest about what none of this tells us. It doesn't tell us the exact price gold or silver will reach, on what date, or through what path. Anyone presenting specific price targets with confidence is offering a guess dressed up as analysis. What the evidence does support is a framework for thinking clearly about the relationship between long-duration government debt, the credibility of the institutions issuing it, and the role precious metals have historically played whenever that credibility comes into question. Frameworks help you interpret the next piece of data as it arrives. Predictions tend to age poorly and often distract investors from the evidence actually in front of them. Going forward, there are four things worth watching. First, whether the term premium component of long yields keeps widening or stabilizes. This is something professional bond strategists track closely, and while it's not usually front-page news, financial data providers publish estimates of it regularly. Continued widening supports the structural concern narrative. Stabilization suggests this may have been a temporary repricing event. Second, the relationship between real yields, nominal yields minus inflation expectations, and gold's price action. Gold has historically been most sensitive to moves in real yields specifically more than nominal yields alone. If real yields rise sharply while gold holds firm, that's an even stronger signal something structural is happening because the market is essentially discounting the traditional relationship altogether. Third, central bank gold purchase data, typically reported with a lag through organizations that track official sector reserves. A continuation or acceleration of that buying reinforces the structural interpretation. A meaningful slowdown argues for caution. Fourth, how the US dollar behaves during this period. A genuine loss of confidence in long-term US fiscal credibility would be expected to eventually show up not just in Treasury yields and gold, but in dollar weakness against other major currencies. If the dollar stays strong even as this story develops, the concern may be more specific to government debt instruments than to the currency itself, at least for now, which is worth noting. None of this should be mistaken for a signal to make any specific financial decision. The point of walking through this evidence isn't to tell you what to do with your money. It's so that when you see headlines about bond yields, inflation, or gold prices in the weeks ahead, you have a clearer framework for understanding what's actually happening beneath the surface instead of reacting to whatever emotional framing a headline chooses to use. Markets reward patience and clear thinking and tend to punish decisions made purely out of fear or excitement, regardless of which direction that emotion points. Back to where we started, a 30-year Treasury yield quietly reaching a 19-year high isn't, by itself, a dramatic event. What makes it worth this much attention is what it might be revealing about a slower, deeper shift in how the most sophisticated capital in the world is beginning to think about long-duration sovereign debt. And the unusual resilience gold has shown in response, breaking from a decades-old pattern many investors assumed was a fixed law of markets rather than a historically contingent relationship that changes when the underlying conditions change. The honest conclusion is that we don't yet know with certainty whether this is the early stage of a genuine structural shift or a temporary anomaly that resolves within a matter of weeks. What we do know is that the evidence currently available, the persistence of central bank buying, the widening term premium, and gold's refusal to sell off alongside rising yields leans more toward the structural interpretation than markets have leaned in a long time. That isn't a prediction. It's an honest reading of where the weight of evidence currently sits, with full acknowledgement that new data in the coming weeks could shift that reading in either direction. Here's the question worth sitting with after this video ends. If the bond market, historically the most rational and least emotional corner of the financial system, is beginning to demand more compensation for holding long-term government debt, what does that suggest about how the rest of the financial system, stocks, currencies, and eventually consumer prices might need to adjust to reflect that same underlying reality? And how prepared is your own thinking, not just your portfolio, for that possibility? If you found this breakdown useful, consider giving the video a like. It helps more people find evidence-based analysis instead of headline-driven noise. Subscribe if you want to keep following how this story develops week by week. And if you want to go deeper into the recent silver market signals we've been tracking, there's another video linked right now that walks through exactly that.